Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
If you've been listening to our podcast, you're like, man, I love what you guys are talking about. I want to build passive income through one of these 5 pillars that you're talking about, but how do I do it? Stallion, tell them it is so easy.
It's so easy that we created the longest URL possible, so you may want to write this down, freecall.wealthwithoutwallstreet.com. Go to freecall.wealthwithoutwallstreet.com and you can set up your call with one of us. We're excited to talk to you. Welcome. This is the Wealth Without Wall Street podcast. Your host, Joey, the Italian Stallion Murray, joined as always by Russ, the Idea Guy Morgan. Russ, it is about time we took something out back, picked a switch, and beat the living daylights out of it.
Oh, old school whooping style.
I mean, just like old Montgomery style, like you used to have.
Yeah, man, I've had
You had your fair share?
I've had a whooping or two. I was a hellion as a kid.
But what are we talking about, Russ? We're talking about opportunity zones. These things need to be brought to task here.
Yeah, and it's one of those things. On the surface, you and I were in on this. I mean, to be honest, we actually were interviewing an expert to be on the podcast because we were like, this seems awesome.
Yeah, our clients want to know this stuff, right? They want to understand how to get tax breaks on real estate investing that they were going to do anyway.
Yeah, I want to invest in the social good of the impoverished areas that, you know, the downtowns that maybe are not getting the monies that like the New Yorks and the Massachusetts and the Californias get.
Yeah, the venture capital funds are kind of already dictated to those areas for the most part. So this is going to help kind of democratize that venture capital funds. But that's not really what was happening, was it?
Well, you know, one of our old friends, Nelson Nash, tends to help us open our eyes or see things through different lenses when he says, you know, when you take a government plan, you read its mission statement, the result is usually 180 degrees the opposite, right?
Yeah.
And as we started digging through this, what happened is our eyes got really focused initially on the social good, the tax benefits, how this is going to benefit me, right? I mean, just selfish, greedy individuals that we are. But then as it starts playing out, we start hearing the word fund. Wait a second. Fund is a word that I recognize from my investing days.
Right. It's got the word fun in it, right? But It's not fun for you and me.
Yeah, but that D on the end, right? the more important words is the D and the F. No good.
Well, it's fun for somebody else.
Yeah. Well, it's a Wall Street term, isn't it?
Absolutely. Yeah. The mutual fund manager is having all the fun.
Yeah. And then they started talking about like, oh, this was a government created plan for your money.
So I feel like we've heard something else about that before. Has the government created any other plans that we don't like?
Well, they created some plans that lots of people use, but you and we've broken down on this podcast many times, maybe not in our benefit. And this started aligning very similar because one of the things that I heard was, oh, I'm going to give up control of my money for a minimum of 10 years if I put it into this opportunity zone.
Now, okay, so granted, some people may be looking to invest in real estate anyway, and they say, well, this fund over here is already investing in these areas that I want to be a part of. So what's wrong with that?
Well, no, that's a good thing, right? I mean, when we talk about our hierarchy of wealth, we talk about investing in things that you know. And a lot of times real estate will fall somewhere between that tier 2 and tier 3 level, because if we understand it, if we can purchase it, it's tier 2. If it's backed by collateral, that's tier 3. On the surface, it seems like that. But as you start breaking it down, Joey, are you the one controlling the actual investment that you're putting the money in?
No.
So that's not tier 2.
No.
3, are you actually owning the real estate, and do you have the ability to go sell it if the market's going down?
No.
If you did sell it, and we're kind of breaking all of these things down a little bit early, but I want you to hear why we're talking about this, and we'll go back, because if you don't know about opportunity zones, we're going to kind of bring you up to speed on this. So we'll give you the ABCs, if you will. But there's just some basics in here that if I want to get in and out, I can't do that because I am in a fund.
Okay, but so how important is that, Russ? I mean, getting in, getting out, like you're making that like it's a big deal.
It's everything, right? So let me give you an example. If I own a grocery store, is my objective to sell all of the goods on the turnstiles, or whatever you call them, the gondolas, right? Is my objective to sell those at the highest price possible for one time, and once they're all gone, I close the store and I cash out? No, I can't make enough.
That's not sustainable.
I can't make enough money in that game, right? It's not, there's Academy Sports right down by our house right now, and, they're selling everything because the rent went up so much on their property, they're actually having to move. And so they're selling everything in there, and it's a free-for-all in that place. and they're trying to get all the dollars off the shelf as much as they can. But if they were going to stay in business in that location, that would never work.
Yeah, not a chance.
Because how many times have you ever gone back to a place that didn't have what you want and keep repeating as a customer? You don't, right?
No.
So grocery stores don't operate under the premise of, let me sell something at the highest price and only sell it once, nor does any business, by the way.
Right.
They operate under velocity. How frequently can I sell this good? So I put it out there. I make a 20% profit, a 5% profit, a 50% profit, and I take that money and go buy another one, and I sell it again, and I do that process rinse and repeat over and over. Well, when I apply that concept of velocity, motion, to this, it fails that first test.
It's a dead end. It's the Dead Sea, if you will, right?
Yeah.
And quite frankly, we're not the only ones thinking about this. The expert that we interviewed said that there are people meeting with the experts or the legislators and saying, "Hey, by the way, we're all in on this opportunity zone fund thing. One problem: we don't want to have to leave the properties or the assets that we're buying in these funds in there just for 10 years. Some of these, we want to be investing in businesses that we want to get in and get out within a couple of years, few years. And guess what? They're not going to put money in these until that is changed."
Yeah. So let's press pause here, because I think we if you're hearing what we're talking about, but you don't know what an opportunity zone is, you probably need some basics. Okay.
Yeah.
Opportunity zones at its base level, go.
All right. So 2017, these came out as ways that there's two congressmen that presented this as legislation and said, okay, we want to identify the lower 25% areas in each state that each governor can decide what those are, and allow people to invest in those areas, whether it be businesses, real estate, or other types of investments in those areas specifically, that you can roll over capital gains. If you have a gain, you can roll it into these zone funds and only have to pay like a 15% discount 7 years later.
Yeah. So if I have an investment today, and it doesn't matter what it is, oil and gas, stock, real estate,
Right.
I can delay paying that tax, that capital gains tax on that investment, and I could take that money and I can invest inside of one of these opportunity zones into a business, fund, or a fund for real estate, or whatever it may be, and I can delay paying that tax. So usually in the past, we've had this, if you're a real estate investor, you know the term 1031. I can have a sell of a piece of real estate, and I can invest that money into another like piece
property,
of real estate. Well, this opportunity zone said, okay, hey, we're going to give you the ability to roll any gain that you have into this opportunity zone fund. So I automatically, my ears perk up and go, oh,
That's
that seems
cool.
good. Now, I don't own any stock, right? But hey, got some real estate. If I want to sell it, because hey, this is a good time to be selling real estate right now.
That's right.
The market is starting to soften up, but we're a lot closer to a high than we are a low.
Yeah.
And so maybe this is a good idea. Maybe I should take some gains and throw it in here. So how does that work? Give the basics on that.
All right. So I'm not going to be the expert on this, but what I heard, and you can confirm with me or not, is that once you put that money in, that gain, you're still going to have to pay a tax on that gain, but it's going to be at a 15% discount by 2026. So you're required to pay that portion.
All right. So example, if you had $100,000 gain, you don't have to pay tax on it today. You roll it into this new fund, and at 2026, now this has changed a little bit as we talked to him, right? It had to meet a 7-year test, but when all of this was assumed, by being put into legislation 2 years ago, like, oh, well, by 2026, they would have met that test. But yet the Treasury hasn't come out with enough information for them to actually start investing. So even though this legislation came out 2 years ago, nobody's investing in it yet.
Right.
They're collecting money, but they actually haven't been able to buy the actual investments because they don't know.
Nothing's clear.
Truly what's going to happen.
Yeah. So they take that gain, and again, I'm just using these for instance, but by 2026, you're supposed to have paid that tax at a 15% discount.
Yes. So the $100,000 I would have had to pay tax on, let's say $20,000 on, and 2026, I get a 15% discount off of that $20,000 tax bill.
Right. It's kind of like buying a shirt today and getting to wear it, and then getting the discount later.
Yeah. Hey, sounds good. I don't know about, wearing a shirt for 7 years, but good for you if you're doing that, Stallion.
But the real kicker to this was that any gain that the initial investment that you rolled into this fund were to have, if you kept it for 10 years, you don't have to pay gain or tax on that gain. So use that same $100,000 example. If I rolled a $100,000 gain into this fund and it grew to $500,000 in 10 years, the $400,000 gain that initial investment earned, I don't have to pay capital gains on.
So immediately you're like, okay, again, tell me why this is a bad thing. Like this is sounding good.
Russ.
Like you now understand why we were interviewing people about this. Why I sat on another 1-hour call with a guy who was talking about, creating one of these funds and looking for people to invest in it. This sounds good. On the surface, it sounds good. But here's some things where this thing starts going wrong. As we mentioned before, I have to keep the money in there for 10 years. I don't get to choose. I can choose which fund I go into.
Right.
But I don't get to choose when to sell it. So let's just say, okay, great. I buy into this marketplace now, and the marketplace is low because if I'm buying in an impoverished area, the real estate should be cheap. The ability to get in, the overhead's going to be low. Man, all of this is sounding good. Well, if everybody else starts investing in it, what's going to happen? The values of that property should tend to rise because of it. If all of this works the way the government wants it to work, then but how do I know it's going to be at its peak 10 years from now and not 4 years from now, not 6 years from now?
You're not in control of that?
No. If I sell out, then I have to pay all that tax that they were talking about.
Right. Before the 10 years you're talking about.
Exactly.
Yeah. So you're really having to kind of time it based on someone else's timeline.
Now, what does that sound like again?
Sounds like a qualified plan. In fact, these are called qualified opportunity zones.
And doesn't it sound a lot like Wall Street?
Absolutely. I feel like Willie Wall Street has his hands all in this thing.
Yeah, I mean, when we were interviewing this guy, it took a little bit. I'm slow learner here. And it took a little bit for me to start hearing these things and start going, wait a second. This guy is wanting to get on our podcast and share how people can put money in a fund that he controls the use of that money for how long? 10 years. And hopefully at the end of that time frame is when it will be worth something that they can get back. all under the guise of helping someone else and tax benefits.
I got to be honest with you, Russ. You came in to the office after we got done, and I was just so proud of myself. It's like, man, Russ, that was a great podcast. I really like this. And right out of your mouth, you're like, we're not putting that crap on the air. And I'm like, what are you talking about? I got lured in. Yeah. I mean, I'll be honest with you. As much as we talk about these things day in and day out, I'm hearing that and I'm just getting lured in. So trust me, we're all in this together. We're all learning together, but it's that easy to see, to fall into that Wall Street mindset.
Well, I mean, shouldn't we be able to invest though into things without having to worry about someone else's rules?
Well, we would hope so, but we've been told that we need to go by somebody else's rules.
I keep going back to our trusty becoming your own banker, right? This is the trusty Bible here, and it has so many things for finances that continue to hold true. And one of those is who has the gold makes the rules.
Yeah, that's the golden rule, right?
Yeah. And when we transfer our gold into others' hands, and in this premise, it seemed great. So I'll give you another example. Hey, look, this may be a great investment opportunity, Joey, but I want to compare it. If I could earn 25% on this investment over the next 10 years, but I can't touch it for 10 years, I cannot do anything with it. How does that compare to something that I can put my money in and earn 1 to 5%, for instance, but do that 100 times over the next 10 years?
I mean, on surface, it sounds really good. 25% over 10 years. I mean, if that's year in and year out, man, it sounds pretty good.
But when you compare it to the alternative, right? Because we've done podcasts on how opportunities find what?
Cash.
Do they find funds?
No.
They don't find funds. And the
now,
thing
funds find cash.
Funds find cash. If you're running a fund, hey, I get it.
Good for you.
You're going to make some money in this deal. There's no doubt. I watched that from Wall Street's perspective. I watched how fund managers make lots of money. You want to go find the people who make tons of money? Find a hedge fund manager.
Yeah.
I mean, tons of money. I mean, millions and millions of dollars. And you know how long they do that for? The average life cycle, work cycle of a hedge fund manager? 2 years.
Wow.
It's crazy because the pressures that are on them, but also they make so much money in that time frame, they can unplug.
Well, let's go back to that example for a second, because I think there's a couple of key points that we need to point out here. If I have something that I cannot touch for the next 10 years, am I going to put the majority of my funds that I have available or the minority?
I wouldn't think I'd put a ton of money in it now.
Well, it's just human nature. I'm not going to put everything into something like that because I can't touch it. I can't use it. It's just like your example of selling everything out. I have no sustainable business at that point. But if I have something that I can turn over and over and over again, how much of my money can I put in there?
As much as you can.
That's a much higher volume of your assets that you could put at work rather than the minimum amount that you can live without. Again, going back to qualified funds, qualified plans, that's the mindset behind those.
Well, isn't the purpose of everything we're doing, like that goes back to why are we doing what we're doing? And this is the question that I think is the first question you ask yourself before you put a dollar in is, does this meet my first objective? And I don't know about you, but most of you that I've spoken to, when I ask, what is your goal? It always boils down to freedom,
right?
Time. I am doing whatever I'm doing, or my objective to do what I'm doing is to get more time, to stop trading time for money.
Exactly.
Well, if I am now putting money away and I am hoping that it comes back, I'm not necessarily assured of buying time in the future. I'm hopeful of it. So also, what are some of the things that, I mean, I love getting on calls and talking about what vacation are you taking this year? How are you enjoying the things of life? Because when our kids are the ages that they are, how are you taking advantage of that? And when I hear, oh man, I'm going to Europe with my kids this year, or I'm doing an RV trip across the country with my kids, or I'm going to Disney for 2 weeks with my kids, like all of those things are what fire me up. Well, that's because people have access to money and the ability to use it. Well, the money that's in that fund,
not gonna be used.
No RV trip.
Yeah.
There's no Disney trip in there. There's no way for me to find short-term loan opportunities. I mean, you and I have done some loans, couple 100%. Don't think bad about us. I know I just said that and you're like, whoa, man, you guys, snakes. A couple 100% because we borrowed money from the insurance company at 5%. We lended at 25%. And the ultimate return on it was a couple 100%.
Yeah.
But those were deals that we can do. You're not
over and over again.
Yeah, you can repeat those. I mean, that individual came back to us a couple times, didn't he?
Yeah.
So, I mean, here's the thing to that is that opportunities find cash. And when we try to find the golden bullet, like this is what I see these opportunity zones. Like, oh, this is my golden bullet, right?
Yeah, exactly.
I put my money in here, man, I get to, avoid some taxes. Well, maybe it's not necessarily as good as it could be because real estate as a whole is a great tax avoidance strategy. I mean, we get to write off a ton of stuff already with real estate.
Absolutely.
And if I can get in and get out at my own terms, why am I trying to avoid just a little bit of tax on something?
Yeah, it doesn't make sense. I think we have to go back to, and you mentioned this earlier, but the hierarchy of wealth, if you haven't listened to that episode, you need to go back to it. It just breaks down a logical, step-by-step way that you can get to freedom. And you don't have to step into these speculation type of investment vehicles, which most Wall Street is all speculation. So start out with cash. Start out with cash values. And we talk about life insurance because it's the best alternative to cash and how you leverage that into the next tier, which would be like your own business. Or if you're a real estate investor, that would be tier 2 because you know about real estate. You know about investing in real estate and how to make that work for you. But then tier 3 would be any kind of collateralized assets, whether it's be real estate or lending or something along those lines. So again, if you stick to this and you, again, don't get drawn into with these tax incentives and these types of ideas, but you take more control, you're going to get to your end a lot faster. And again, like you said, being able to turn it over and over, the velocity of that money is way more important than the rate of return.
The second tier in this, I think, is what allowed us to see the flaw in it, in this opportunity zone.
Okay, what do you mean by that?
It was us investing money and time to learn about it, right? Because that's what we say is tier 2, is the thing that you invest in that gives you the most influence over, that creates the most control, is our knowledge base. It's educating ourselves. It's building networks. Well, when we started investing the time to learn about opportunity zones, we were curious, right? It gave us like, oh, this seems interesting. We probably should figure this out. We started asking clients, is this something you're into? They said, yeah, okay, great. All right, so let's invest a couple of hours. Let's start there, and then we'll go deeper. Because our intention was, if we're going to interview somebody, is to find out more about it. So for us, because we use this as something we teach you, but the whole time we're learning and trying to figure it out. And if we do it and have success, we'll share it. If we do it and we fail miserably, we'll share it. Right? I mean, that's the beauty of what our podcast is about, is to teach you, is to help you, right? And I think that investing in that part, because so few times do people understand and invest into themselves to learn about the things that they are going to invest in. It just makes this quick emotional decision. Okay, this makes good sense. Let's go ahead and do it. But for these sort of things, you need to invest some serious knowledge. And when we started doing that, the onion was peeled back, and it started really looking like, okay, wait a second. It's like that picture, you have that picture where you can see like the beautiful person, and then when you look at it from a different angle, it's like this old hag. You've seen that?
Yeah,
imagery?
Absolutely.
It, like, initially it was the beautiful woman, and then the more we started looking at it and figuring it out, all of a sudden, wait a second, no, this thing's an old grummy hag.
Well, now I'll all of a sudden have that picture in my mind. So thank you for that, Russ. But at the end of the day, you want to put money in opportunity zone funds, you go ahead and do it. But what we wanted to uncover for you today is the Wall Street mindset that is driving those things, and that you don't have to fall prey to these things. This is something that you can take more control in the things that you know and understand, have been educated on. You can invest in the things that you understand. And again, like you talked about, within your business, you're turning capital over and over and over, so you can do it at a much higher volume. I think there's something there that we probably need to cover at another time.
Well, and don't limit yourself too. Don't limit yourself to only a few investments, because that's what's happening here. I mean, think about the 401ks that you've had in your past. Sure, that Capital World and Growth Fund looks great as compared to the other 9 options in your thing. I mean, you got 10 options.
Wait a minute, you can't just choose whatever you want to invest in 401k?
As long as it's one of those 10 options. All right. Oh, my company, they got 32 options. What you boys
the menu about? Of options.
I mean, that's just like, it's not the end, right? It's not the freedom and opportunities that exist that just come on this one little menu. I like ordering off the menu.
Exactly.
You know, I want to know what's special. Right? That there's the opportunity, not in the, the 15 things that are listed in this area that I can potentially put money in, and then I hope that you do a good job with it, because I no longer have control over it.
It's not a strategy, Russ. We've talked about this numerous occasions. Hope is not a strategy.
No, it is a strategy. It's just not a very good one.
Oh, okay. I'll give you that. But if we're consistently playing by someone else's rules, and if the someone else is the government, those rules can change. I don't think that that's where we want to end up.
No, I think you keep more control. You invest in things that you understand. You follow an approach that makes sense to you, and it meets those other guidelines. So if you're in an opportunity fund, the objective wasn't to completely kick you in the knee. I mean, we probably did a couple of times here, but it is just to uncover the areas of where Wall Street keeps popping its head up, and there are ways to build wealth without Wall Street. And we appreciate you listening to this podcast. As always, look forward to having you on the next time.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.